let's start. Give people an idea of what is short-term insurance and what they need to look at.
Lawrence, I think to talk about short-term insurance, we have to take a step back and firstly understand what exactly is insurance and what's the purpose of insurance. Insurance is a risk mitigating exercise. By having insurance, be it long-term insurance, short-term insurance, it does not negate the fact that something's going to happen. Something is definitely going to happen somewhere along in your life. So the idea is to minimize that risk as much as possible. And here we're referring specifically to a financial risk. So the act of you losing money through something happening. To cover those things, the main two focuses of the financial planning world is long and short-term insurance. Long-term insurance, and I think this is basically the easiest way to understand it. Long-term insurance is any time you're insuring a person and or yourself, your ability to earn an income. Short-term insurance, on the other hand, is any time you're insuring something to a large extent. Yes, it gets a bit more technical than that, but to a large extent, short-term insurance is insuring something. So either your house or your car, or your cell phone or camera, or whatever the case might be.
So just what I was thinking of now is, if people want to put that in perspective, long term, what is the longest thing you will do in your life? You will live. You can't do anything longer than how long you're going to be alive. So that is when you insure something regarding your life, because that's long term. Short term is anything that you will have in your life, because it doesn't matter what you have. Anything that you have, you'll only have for a specific period of time, and then it will disappear or get sold or whatever, and that's short-term insurance. Okay.
Correct, totally. So today our focus is going to be on short-term insurance, usually known as your car and household insurance. Now, again, in order to understand short-term insurance, there's a couple of key phrases I feel we should understand. First and foremost would be the concept of new for old. When insuring an item, you can't insure it for the current value that you think, it might be worth this. Because in the event of something happening to that item, which they deem a total loss, so your car being written off, your couch getting stolen, the house burning down, an insurance company cannot replace those items with second-hand or older items. So yes, you have a couch. You bought that couch 10 years ago for 2,000 Rand. When insuring that couch or that TV or that camera, we have to insure it for a value that is similar to a new similar item. And that's where a lot of people struggle with, because they feel, especially of household contents, I'll only insure it for 400,000 Rand, because that's roughly what I paid for things 10, 20 years ago.
Yeah. Or what it's worth now. If I had to sell all of my stuff,
yes,
I'm only going to get 50,000 Rand for it.
So we always have to understand replacement value based on new for old. When an insurance company indemnifies, pays out a claim to you, they are going to replace that item with a new item. That's the first important thing. That brings us to average, which again we spoke about on the last show as well. Average is the principle whereby an insurance company looks at what is the insured value and what is the replacement value of an item which was insured. This ties in specifically with your household contents and your building insurance. So if you insure your household contents for 100,000 Rand, the insurance company comes in after a claim, they do an assessment and they see your household contents should have been insured for 200,000 Rand, they are going to reduce your claim payout. So new for old, average, it's two very, very important factors to understand.
Yeah, and what people don't understand is, and you get so many unhappy clients because of that, is they come, the guy is insured for 150,000 Rand, they steal the TV, the TV is only 20,000 Rand, and the guy says, but I'm insured for 150, why don't you pay out my whole 20,000 Rand for my TV? But he should have been insured for 300,000, therefore they're only going to pay out 10,000, not the 20,000.
Correct. And that brings us to that age-old question of, should I use a broker, yes or no?
Yes.
And I don't want to dwell on this subject, but the layman out there does not understand these concepts. And I don't blame them for not understanding. The industry for so many years has tried to keep these things a secret, insider knowledge. And that's why clients sometimes feel that insurance companies are out there to screw them. I had to think of a polite word over there.
Yeah.
So, because they do not understand the basic concepts. Should I make use of a broker? Should I make use of an advisor? Should I get help in planning? Yes, you should. Guys, if you look at the premium difference, 9 out of 10 times, somebody who's in the financial services industry would get you a more competitive premium than you just phoning a direct insurer.
And for me, there's two things there. There's been a mushrooming of direct insurers. People just phoning. Now, the purpose of a direct insurance, and I think the emphasis on price only has become a problem in the short-term insurance industry, because the direct insurers, they're not really focused on making sure you are correctly insured. They are there to try and beat the premium that you're paying at the moment at any cost, because they're not advisors. They are people sitting there in a call center, and their job is to quote as many people as they can and beat as many premiums as they can. And that, I think, there has to be a balance. Like I said in the beginning, it's about getting the correct insurance for the best possible premium, not just get the best possible premium. So this whole thing about save 300 Rand on your car insurance, be very careful of those kind of things.
There's another hidden factor which people seldom understand, and that is the whole concept of an excess. And that again ties in with, I just saved 300 Rand on my premium for my car or for my household contents. Yeah. Excess is what is defined in the financial industry as the portion a client contributes when a loss takes place. So seldom, if ever, will you be insured for 100% of a financial loss in the short-term insurance industry because of an excess. And excesses can vary dramatically from insurer to insurer, even from product to product with a insurer. So always make certain what your excess is and plan according to that. It's fine saying, I've saved 300 Rand on my car insurance, but in the event that I have a claim, I now need to pay an additional 10 or 15,000 Rand as an excess towards my portion of the loss. Whereby paying 300 Rand extra can dramatically reduce your excess amount. No. And again, it gets down to planning and sitting down with somebody who understands these things, who can do a proper analysis for you so you can understand what would happen in the event of a claim. If you're in a situation where you have access to additional funds, where you know I can cover this excess, then by all means take a higher excess, save premiums on a monthly basis, use those savings and build up towards investing in yourself.
And then you can start self-insuring.
Yes.
Over time, because you can build your own little security for excesses, increase your excesses, pay less premiums.